This video is part 2 in my 3-part series, which is a recap of what I went over with my investors during my annual meeting in January. So today in this video, we're going to talk about what I foresee happening in the marketplace in general and try and explain to my investors why, even though they've given me their money to invest, I've kept 40% of it in cash and not invested in the marketplace. So I'm going to start with some fundamental thoughts because I've got to cover some issues which I can build on as I go through this video. So the first thing I'm going to talk about is what exactly is investing. Investing is paying for something today that you believe will be worth more in the future. It's pretty simple. It's a pretty simple concept, and that's really what I'm trying to do. There are two fundamental ways that you can create that value. The first is what I'm going to call and what value investors call investing. And the second is what we call speculation. So investing is buying something that is capable of creating its own value irregardless of the market. So an example is an apartment building. An apartment building creates its own value because you get rents every month. And while those rents may fluctuate, there's no question that an apartment building does have an ability to create value. And the market for apartments in your town might fluctuate over time, but there will still be an ability to create value through the rents that are received. And so investments that work that way would be stocks, because you can earn dividends, bonds, you can earn yield, real estate, you can earn rental income. These are examples of what I consider investing, buying companies, buying investments that have their own ability to create wealth. Speculating is buying something now that you believe the market will pay more for in the future. So something that is a speculation doesn't have the ability to create value on its own. The value can only be created through the market. So examples of speculation would be art. There's no question art might go up in value, but it doesn't generate value other than if some other guy's willing to pay more for the art than you paid for it. You know, if you collect coins, but also other things, gold and silver don't create their own value. Somebody's willing to pay you more or less than you paid. Another prime example in today's economy is Bitcoin. I don't know what Bitcoin is worth, but I know that if I own Bitcoin, it's not going to ever throw me off a dividend. It's not going to ever throw me off a yield. It's not going to ever throw me off any rents, right? It's just the fact that other people think Bitcoin's going to be worth more in the future than it is now. I don't know if that's true or not. I'm not a speculator. I'm an investor. So what I'm trying to look at is buying companies that are generating more value in the future than they generate now. So let's focus on investing. Investments are measured in common ways. So real estate is commonly measured in cap rates. A cap rate is the relation of the rental income to the price. And so if you spend $100 for a building and it pays you $10 in rents, that's a 10% cap rate. And that's how, as a real estate investor, I can quickly determine what the relative price of that building is. Because you're going to have two different buildings that have two different sets of numbers. One building might have 500 apartments and the other one might have 300 apartments. And so how do I compare those against each other? And that comparison is typically done through cap rates. Bonds are measured by yield to maturity. So yield is the amount of interest that you receive from the bondholder, and that's different depending on who issued the bonds. A highly risky company will pay you a much higher yield than the government, for example, because there's very little risk. Stocks are typically measured in two ways, which is yield, which is the dividends that are paid, or they're measured in PE ratios, which is the relationship between the earnings of the company and the price you're paying for the company. So a company with a PE ratio of 10 is earning $10 and you're going to pay $100 for that stock. So that's sort of the way investments are commonly measured. And it's important to understand these fundamentals as I go through the rest of this video. The next thing to understand is that investors are expecting to get paid for risk. All investment has some kind of risk. It doesn't matter what it is. You could buy Walmart and you say that's a great company, it's going to be around forever. Well, people probably thought that about Polaroid and Kodak, and those companies eventually went away. So no company is without risk. No investment or bond is without risk. And investors expect to get paid for that risk. There is something called the risk-free rate of return, and that's considered to be a government bond, and that rate of return is 4.2%. So if I have virtually no risk, which is a government bond, and I get a 4.2% yield, one would expect all other kinds of investments would pay me a yield higher than that 4.2% because there's more risk. I hope that makes sense. So to put that in perspective, the government bond pays a 4.2% return. Real estate, which is more risky than a government bond, pays better returns. Multifamily is about a 5.5% return, so about 30% more. Industrial buildings are slightly higher than multifamily. And office buildings, as you might imagine, are significantly higher returns because there's much more risk. Because due to COVID and everyone working from home, nobody really knows what the value of office buildings are anymore, and there's certainly risk that all your tenants are going to move out. And so you understand that there's a relationship between risk and return. So now let's look at those concepts and apply them to the stock market as measured by the S&P 500. So stocks, as we mentioned, are paying a dividend, are measured based on their PE ratio. And we talked about the PE ratio as the relationship between the stock price and the earnings of the companies. So to convert from a PE ratio to a percentage return, you simply divide 1 by the PE ratio. So let's put this in perspective now. The S&P 500's current PE ratio is 29.74. So if you take 1 and divide it by 29.74, you get a 3.3% yield. So a 3.3% yield, we've already talked about it. The government bond has absolutely no risk. Companies have significant risk, and yet the government bond pays significantly more return, over a 30% return more than a government bond. So again, we've got real estate that reflects there's a certain amount of risk, whether it's multifamily or industrial buildings or office buildings, but at the price the stock market's at, not only it basically said the stock market is less risky than a government bond, and that's an irrational thing to believe. And it's an indication, a significant indication. It's kind of a long-winded way of me saying the market is really overpriced when you expect a lower return from the stock market than you get from a government bond. And that's a significant red flag for me for why I'm not really interested in being heavily invested in a lot of the companies in the stock market. So let's talk a little bit about what exactly the S&P 500 is. So the S&P 500 is basically the 500 largest companies in America, and they're all pooled together, and the results of those companies are tabulated every day or every second, really. And that way we can see it's a proxy for the market and for the economy. As the S&P 500 goes, so does the stock market, and in theory, it's reflecting the economy. And remember, there are thousands of public companies. These 500 in the S&P 500 are just basically the largest. Now, some historical percentage, the historical average PE ratio of these companies is about 18.5%. So if you go back, 100 years in the past and you average it all out, the return for the S&P 500 generally is the PE ratio is about 18.5%. 18.5. The current PE ratio is 29.74. So it's 165% of the historical average. There is no explanation or reason to believe that companies are better now than they've been over the last 100 years. It's just that investors are willing to pay much more for those companies. The result is that future results, the companies have to perform ever and ever better to generate the fair return on these investments. And I just think that they're very, very overpriced. So when considering data points, I like to look at things from lots of different perspectives and try and get a ever clearer picture by doing that. So let's look at the S&P 500 a different way. In 2023, the economy, as measured by the GDP, which is gross domestic product, grew by 2.9%. In 2024, the economy grew by 2.4%. Now, the S&P 500 is a proxy for the economy. It's the 500 largest companies in that economy. And somehow those companies went up by 26.29% and 25.02% over those same 2 years. So there's a massive disconnect between what's happening in the economy and what's happening in the S&P 500. Now, if that was the only piece of data, that might make sense. For example, it might be that the S&P 500 was dramatically undervalued and it was catching up. But that's not really the case. There's other data which leads me to believe that's not true. So this is a red flag to me that, hey, there's something going on here and we need to be wary. Look at this same kind of thing through a different perspective. So the S&P 500's earnings, one would think, over some period of time would reflect the stock prices, right? So in 2023, the stock the earnings of the S&P 500 grew by 7.79%, but the value of the companies in the S&P 500 grew by 26.29%. Doesn't seem to add up. In 2024, believe it or not, the S&P 500 lost, the earnings shrunk by 0.5%. Now, that number isn't completely accurate because we don't have all of the earnings for all of the companies in yet. They tend to report, over the first quarter of 2024, of 2025. But basically, it's going to be in that range. So we have the earnings that are up 7.9%, and yet the companies that are reflected, their stock price grew by 26%. The next year, the earnings were pretty flat and a little bit down, and they grew by 25%. So that doesn't make any sense. By the way, the numbers that are here in 2024 are reflective of another fact. Warren Buffett just came up with his annual report, and he reports in there that Berkshire Hathaway owns 189 companies. That's companies they own directly or subsidiaries of companies they own directly. 53% of those 189 companies made less money in 2024 than they made in 2023. And that dovetails with and mirrors the results that I've got here for 2024. So explain to me why the GDP is not going up hardly at all. It's very anemic. Earnings aren't going up very well. And you've got these fantastic returns, the S&P 500. Again, these are very, very much red flags to me. One of the reasons for it happening, I have to do a little more foundation building. So again, we've talked about the S&P 500 being the 500 largest companies. They are a proxy for the market and the economy. But one of the things that you won't probably get is that the S&P 500 is not equally weighted, it's not equally distributed. So it's not 500 companies, each of which have 0.2% of the S&P 500. The larger companies have a larger proportion of the stock market than the smaller companies. The smaller companies are disproportionately underrepresented, and the large companies are disproportionately overrepresented. So to put that in perspective, the bottom 52 companies in the S&P 500 equal less than 1% of the results of the S&P 500. And we're going to talk about why that's important in a minute. But just to give you a sense of the companies that combined don't equal 1%, Ralph Lauren is 0.02%, Fox Corporation is 0.02%, Campbell Soup, Caesars, Hasbro, all are 0.02% of, so not 1%, 0.02% of the S&P 500. American Airlines is the largest airline in the world, and it's 0.02%. Best Buy is 0.03%. So you add up all these companies, Ralph Lauren, Fox, Campbell Soup, Caesars, Hasbro, American, you add them all up and throw in another 45 of the largest companies in the world and all in America, and they all equal less than 1%. That shows me that the S&P 500 is, in my opinion, not as representative of the economy as it ought to be. So I've talked about how the bottom 52% of companies are less than 1% of the S&P 500, but just as stunning, the bottom 247 out of 500 companies equal 10%. So 90% of the market is made up of the top 250 companies, and the bottom 250 companies, 247 companies, equal less than 10% of the market. These are not normal. This is something that has occurred over the last few years. And the reason for this is because the large companies are so overrepresented. So 4 companies equal 21% of the market. Those 4 companies are Microsoft, NVIDIA, Apple, and Amazon. The top 10 companies equal 37% of the market. So you've got these 500 companies that are a proxy for the economy, and really what's happening is 10 companies represent almost 40% of the results. The top 50 companies, just the top 50 companies, are 58.6% of the market. And so what you have is, you don't have a situation where the S&P 500 is a proxy for what's happening in the economy. You have a situation for these 50 companies, which are not representative of the economy, are doing very, very well, and they are skewing the results of the S&P 500 and making it look much more valuable than it is. So the top 50 companies equal 58.6%. So now let's put those numbers in further perspective and understand why this dramatically overweighting of big companies is dramatically skewing the results, and again, what I think the ramifications are going to be. So we've talked about that the market PE ratio is 29.74%, that the historical PE ratio is 18.5%, And so the market's 65% more expensive than it traditionally is based on the earning power of the companies in the market. We've talked about the historical average is 18.5%. We talked about the market being 29.74%. But now the four largest companies, which are 21% of the market, are trading at a P/E ratio of 44. So that's over 200% of a historical average. The top 10 companies, which are 37% of the market, are trading at a P/E of 36. And the top 50 companies, which are 58% of the market, are trading at a P/E ratio of 40. So these companies are all over 200% their historical average. And there's only 50 of them. They're very, very expensive, and they're very, very tech heavy. And the result is, this is, to me, is a giant red flag that we've got a market which is really overrepresentative of very large companies. And those few large companies that it are represented by are very, very overpriced. And I think that's one of the major reasons why there's this big bubble forming. Here you can see a chart of the Magnificent Seven, which is sort of the 7 largest companies, and how their share in the marketplace has grown dramatically over time. And this is the highest proportion that it's ever been. The market has never been this overbalanced in terms of large companies in the past. Let's look at the market through another perspective. The historical dividend yield average is 2.89%. The dividends paid in 2024 are 1.2%, the lowest yield in history. It's 20% down from last year. And so if the market wanted to get back to a yield of 2.89%, either earnings would have to double this year, or the stock prices have to cut in half. And I think that when you look at the P/E ratio being twice as high as it should be, that implies the market's probably going to cut in half unless earnings dramatically go up. You look at the dividend yield is twice as high as it should be, that implies that the market should cut in half. Yet another perspective that I have is Warren Buffett. Warren Buffett is the gold standard for investors. We've talked about this in the last video, that he's got these outsized returns, and he's one of the richest men in the world, and he's done it simply by compounding money. And he's done it by buying very conservative companies and holding them for a very long period of time. When I went to 50% cash in October, Warren was about 275 billion in stocks and 275 billion in cash. Since October, 4 months later, he has 325 billion in cash and 266 billion in stocks. So he's dramatically increased the amount of money that he's got in cash and decreased the amount of money he has in stocks. Another thing to think about is there's something called a Warren Buffett indicator. This is the relationship between the value of the stock market and the value of the GDP. So what he's saying is the stock market should reasonably approximate what's happening with GDP. If the GDP is going up, so should the stock market. If the GDP is staying flat, so should the stock market. When you look at the Warren Buffett indicator, you can see that it's twice the historical norms. Typically, without getting into too much, typically the stock market's value is on average about 0.93% of GDP. Today it's over 200% of GDP. You can see that the stock market has never been higher than it is now in terms of the Buffett indicator. And so again, we're just seeing red flag after red flag after red flag after red flag, and there's no green flags. And these are the reasons that I'm so heavily in cash, and it's the reason that I'm being so conservative. So let me go through the summation of the market here. I've demonstrated to you that the market for the last 2 years has been growing faster than the economy. I don't think that's a sustainable long-term trend. I've demonstrated the market is growing faster than earnings. Again, I don't believe that's a sustainable long-term trend. Dividend yield is the lowest it's ever been. The stock market would have to cut in half for it to return to a norm. The market is very top-heavy in terms of mega large companies. The market is also very top-heavy in terms of one sector, which is technology. The market PE for the entire market is 65% over historic norms. 58% of the market, which is the 50 largest companies, are over 200% of historic norms. Warren Buffett is at 60% cash. It's the first time he's been that heavy in cash since the 70s, right before the Nifty 50 crash, which is an historical event where the 50 largest companies were really, really overbought, and they subsequently crashed. The Buffett indicator is the highest it's ever been, and it's 200% of historic norms. Another point I want to talk about is my own anecdotal evidence from my research. I've looked at 702 companies this year. I see trends when I look at those companies, and effectively the 702 companies are randomized, and so they represent all different sectors of the economy. And I see weakness in the market, not strength. Again, I talked about it. Warren Buffett says 53% of the 289 companies that he owns that are very conservative companies had less earnings in 2024 than they had in 2023. And we talked about how, while the results aren't final, it looks like the S&P 500 companies' earnings will be slightly down relative to 2023. So you add all that up, and it's not a very rosy picture. So what are the ramifications of all that? Well, the first thing is that I'm investing my own money. I care a lot about my own money. And the important thing to keep in mind here is if I was just investing your money, I might be tempted to take higher risks to get higher returns. Those higher returns will result in higher fees for me. And, let's just do that. The problem is that because I'm investing my money first and your money is mirroring mine, if I make those really high risk investments and they turn against me, I lose my own money. I don't want to lose my own money. And so I don't care about the fees that I might make managing your money. I care about my money, and therefore I'm going to avoid that risk. Another ramification is there's nothing that says I have to invest. There's a saying that to a boy with a hammer, the whole world looks like a nail. And I think a lot of times you give a money manager money and he just naturally wants to invest that. That's his natural inclination. And I don't have to do that. My goal is long-term results, not short-term results. And the result of that is that I'm perfectly prepared to take lower returns in the short term to avoid high risk. I believe that patience is a virtue. Patience isn't a virtue if waiting is easy. The reason patience is a virtue is waiting is really, really hard. And so I'm just prepared to be stubborn and to wait for good investments at fair prices, which I'm not finding right now. I have no fear of missing out. I have friends who tell me all the time, I own NVIDIA, I'm killing it. I own Bitcoin, I'm killing it. I wish them the best. I want them to be happy. I want them to make more money than me. I don't care. I'm not worried about missing out because I believe in the long run, real wealth is created by avoiding risk, not by taking it on. Another thing to keep in mind is that a lot of people don't understand some fundamental things about math. If you have a 50% increase, let's say you have $100, and in year one you're up 50%, and in year two you're down 50%. I think a lot of people think you're going to break even in that equation, but it's simply not true. So let's do the math. You have $100, you're up 50%, now you've got $150. The next year you lose 50%. 50% of 150 is $75. So now you've lost $75 from 150, you're down to $75. So if you go up 50% one year and down 50% the next year, you've got a net loss of 25%. That's what people don't understand about compounding and about losing money. So I, being aware of that math, am very interested in avoiding risk. The next thing is that because I'm 40 or 50% cash, I'll have ammo when the market turns. If the market turns and if I'm right, stocks are going to get much, much cheaper, and I'll have all of this cash at my disposal to invest in the market. And that means that we'll be buying stocks significantly cheaper than we're buying them today. The next ramification is that I'm a very long-term investor. I'm not looking at what's happened in the market today, this week, this month, this quarter. I'm trying to make us money slowly over the very long period of time. I believe good companies will do well in the long run, but the emphasis is on long, not on doing well. We have to be patient. We have to wait. If we own stocks in companies that are growing over time, that are paying nice dividends, they're buying back stock, they don't have much debt, they're leaders in their industry, it's going to be fine. We're going to do great. It just takes a minute. The final point that I want to make is that I recognize that my very conservative approach might not work for you. You might be looking to go and buy Bitcoin and NVIDIA and these super sexy stocks and get rich quick. And if that's the case, I wish you well, but I'm not going to do it. I completely understand the desire to do that. I completely understand a lot of people don't want to be left out from these fantastic returns. But if that's the way you feel, then you should probably take your money out of my account. I promise you, it won't hurt my feelings. Most of my investors are friends. Most of my investors have been friends for 10 or 20 years or longer. But if they have any hesitation at all, if any of you have any hesitation at all, please feel free to take your money out. I promise it won't hurt my feelings. I want volunteers, not hostages. I want people who are willing to be patient and willing to buy into the fact that I'm doing more homework than them, and I'm trying to think about this much more dispassionately, much more analytical than them. And if you're one of those people, let's just see how things go. But if you really want to get rich quick, I promise you, I'm not the manager for you. And let's just get that out of the way. So that's it for my video on the market. Hopefully this gives you a better understanding for why I'm being so hyper conservative, and that I am not wanting to invest. I'm just not finding things that I think are worthy investing if you consider the risk that's currently involved. Thank you very much for your time.